Welcome back to the channel, guys. I'm your host Buckning, and today we are going to talk about my recent purchase in the company Apple and the stock itself, because this is this is the largest company when it comes to market cap, almost hitting $3 trillion. And when you do these kind of purchases, a lot of people might have a bear case, a bull case, and their expectations around that company. And so I'm just going to address that now because some people have their opinions, and it's best to just address it before it becomes like a thing, which it probably won't. It never does. I just do it because it's in my head and I need to get it out of my head. And so if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So in my last video, you will see that I purchased Apple, and I have in the past couple weeks here, past few weeks actually. And just in this portfolio alone, in the tax-free savings account, and some would consider it not a dividend-paying stock, even though it pays a dividend, very low dividend. And some people think it's too big of a company to have any kind of actual growth. And so I'm going to give you a couple bear cases when it comes to the company Apple itself, because there's always these bears and there's always bulls. So here are a couple of things that I've heard or have read, is that because Mac sales are down and MacBook Pro sales are down or iPad sales are down, that is enough reason that the company will fail. Not necessarily true. I mean, those sectors in Apple make up maybe 16% of the revenue. 16, not 6016. Okay. Bull case, 11% growth in the iPhones, of course, which is their biggest sector. So a lot of people are converting, and higher gross margins in their subscription-based products. So there's that. Also, the other thing is Apple has a savings account now at 4.5%. That's not available in Canada, only available in the US. But that is a huge play. I remember hearing one of the CEOs of a bank do a talk here in Canada, and one of his biggest fears was not actually other banks. His fear were other tech companies like Apple, Google, and this was said a few years ago, and I still remember it. His biggest fear was the fact that there's companies like tech companies like Google, Apple, that are more scarier than other banks as competition, because tech is the big competition where these companies, now you've seen it, they literally know how to grow a company. They know how to create a savings account literally with a partnership of another company. And they are just technologically just advancing in the business and growing the business. And I guess that's why he was the CEO of this bank. I'm not gonna say who it is. But to have insight of that years ago, to not be fearful of other competition in the industry of banks, but fearful of the tech companies that have huge amounts of growth, be the ones that are in competition with other companies, even though they're not technically in the same sector. So Apple, let's get back to it. So there are a couple things you can do to analyze companies, and specifically this company I'm going to talk about, because I know a lot of people probably know what a PE ratio, price to earnings ratio, is. They look at that. They probably know at the market cap of a company. They know where to look for the dividends. They know where to look at all this stuff. But there are a few metrics, there are a few things that you should look into that really determine whether or not a company is good or whether it's bad, because a market cap doesn't say it all, and neither does the PE ratio. Okay, so Apple, what I look for in a company, well, specifically this company, what I look for in any kind of company is the free cash flow, which is gross margins, or sorry, gross profits minus capital expenditures, which give you what is left over. Okay, that is the amount of cash that any company has after they've kind of paid for everything. And so just so you are aware, Apple has a free cash flow of about 100 or 90-some billion dollars for the year. And they can do whatever they want with that money, okay? That is literally money that can be used to pay dividends, used to buy back shares. And we've talked about that on the channel a little bit. It's another way for the company to invest in itself, to create growth, right? They can use this cash to do a lot of things. That's why it's called free cash flow. Okay, the next thing you want to look at is not actually market cap, because a lot of people do understand the market cap. This is the amount of shares that are out there. This is how much it costs to buy the whole company. Yes and no. If we want to look at the true metric of, the value of a company, you don't look at market cap, because you can have two companies that are relatively in the same market cap. Let's just give you an example of a market cap. Let's say $2 million or $2 billion or $2 trillion. Let's go with 2 trillion. Okay. And so they can have the same market cap, but what we want to look at or look for is the enterprise value of the company, because the enterprise value will actually take the amount of long-term debt, short-term debt, and incorporate that into the company's value, the cash on hand. And so that'll give you a more accurate value for the company if you were to buy that company outright and the whole company. Enterprise value is where you want to find it. That's not a metric that is typically shown on Google. I think Yahoo does it somewhere in the financials near the bottom there, but you can look at financials, you can look at balance sheets. Typically you have to calculate this number, but enterprise value is quite important. So if you go onto Yahoo, not sponsored, not endorsed by them, I just use them because they do provide the enterprise value very quickly. If you look at the enterprise value and you look at the market cap, the spread between the market cap and the enterprise value is quite close. Some have a much bigger spread, which means they're not in the best position when it comes to the value of the company. And so that is something you also want to look at. And that is why I'm continuing to buy Apple. Is Apple going to continue to grow? To be honest, I think so. A lot of people might be thinking like there's no way that this company can go to 3 trillion, 4 trillion, 5 trillion, 6 trillion. And who knows? The thing is, I'm sure investors in the past said there's no way companies can get to $1 billion, right? And then they hit $1 billion, and they hit $2 billion, then they hit $3 billion, then $100 billion. Like, it's common to see a $500 billion company. It's common to see a $300 billion company. And pretty soon it's going to be common to see a $1 trillion company. It's not like it stops at $1 trillion. It might end up being 10, 20 trillion, right? And so why would I not be concerned? Because that's just the way it is. I understand the fact that this company could be worth much, much more in the future. And I'm willing to pay for that premium, because you are paying a premium for this company. You are not paying what other people would, or other investors would say, a fair market value. Well, here is the problem with saying something like that, is that I'm willing to pay that premium for a company that performs and returns on average a margin of 24.5% per year on their products. That's 24.5%. The average margin in profit margin is like 15, maybe 10, 10, anywhere between 10 and 15. Apple consistently does that on a year-to-year basis. And so, yes, am I paying a premium for something like Apple? Yes, 100% I am. Is it worth paying? Yes, 100% it is. And I'm not the only one that thinks this, and I'm sure I'm not the only one that has heard, the Oracle of Omaha speak about company. This is, like he said in his shareholders meeting, this is a company that is one of the best companies that they've ever owned out of their whole portfolio, right? And I'm probably going to go along with that. I'm going to agree with it. I'm sure there's a lot of people that do own Apple and own fractional shares, but I don't know if people actually understand the value of this company. And so that's why I'm doing it. That's why maybe other people might do it. Not financial advice, but if you want to look for that growth and you want to look for dividends, yes. If you are a Canadian, yes, it is in the US, and that's okay. It's not good to have a home bias and just buy Canadian stocks, even though there's no tax efficient way for the tax-free savings account to not pay taxes on that withholding tax of 15%. Whoop-de-doo, big deal, right? I'm expecting the growth to be much bigger than a tax of 15% on the dividends. So, yeah. So hopefully you found some value out of this video and taking things out when it comes to looking at a position or a company, because you might be paying a premium. Yes, I might be overpaying for this stock, but don't you think you'd be overpaying for like a Lamborghini when you can just get a regular car? To be honest, right? Like, That's just some way to put it, some way to rationalize some things. Like some people will buy some expensive thing and not realize that it's not worth paying that extra premium. I just think that if it is a nice vehicle, let's say Apple, I'm willing to pay a premium for it because I know how it operates. I know, I understand how it operates. I don't know how it operates. I understand how it operates, and I understand the potential value in the future of this company and the future profits of this company. And so remember, market cap is not the only thing that you want to look at for metrics when it comes to measuring the value of a company. PE ratio, not always the best metric alone. Dividends, anything like that, just really do your research. You really want to get into the financials of the company, the balance sheets, and really figure out, maybe even learn calculations on how to figure out enterprise value on a company and not just look at a market cap, because a market cap can be the same as another company, but another company might be valued more because they have like no debt. And that's another thing about Apple, is literally they barely have any debt. They could cover it, no problem. And so don't forget to leave a like and subscribe, and hopefully that adds some clarification on why I'm buying Apple at this price, even though it's quite high and it's at a 40% return. This is not jumping on the bandwagon. It's just adding a little bit of growth, a little bit of belief into this company, because yeah, it's not that big. It's not too big where it's like, yeah, it's a cash cow. That's all it is. So don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one. Bye.